Hi, everybody. This is Josh Jelinski. We're going to be talking about the supposedly bipartisan, I don't know about that, infrastructure deal advanced to a Senate 67-32. Well, that really isn't bipartisan, but it was above the 60 vote threshold needed. How will this impact economic growth? The nation's budget, I guess two-thirds, I guess you could say it's two-thirds of the Senate. I guess you could call it bipartisan. But why are we spending roughly $1 trillion more? What happened to all the stimuli of last year? How will this impact economic growth, the nation's budget and deficit? And ultimately, how might this profligate spending impact inflation and your finances? And Think Advisors' Harry Stout gives 7 reasons why annuities all of a sudden have more value in 2021. And WAPO, Washington Post, says how to attract and retain employees in a shifting job market for our small business owner clients. And Kiplinger, not even half of U.S. states offer financial literacy classes in high schools. So parents have to pick up the slack. You got to make your kids listen to this show or watch the YouTube. We're going to give you 7 tips to teach investing for kids. And one of the 7 tips I found helpful was to pique their interest with companies they know. Your kids know Amazon, they know Facebook, they know Google, they know Apple, and Samsung are just some of the companies that come to mind. But first, the Bipartisan Infrastructure Deal. How will this impact economic growth? So let's talk about that. So profligate spending will ultimately cause transitory inflation, which is what is happening now, not real long-term sustainable economic growth. And generally, as has been shown by the Great Depression, if we spend a lot of money, it will prolong any recession. And I think professors at like Cal Berkeley found this out. Like, it wasn't like a conservative think tank. With all this volatility in the economy, some takeaways: set up a volatility buffer. So a lot of you are worried about the market. You have a tinge of greed, too. You're like, well, why is my portfolio only up this amount? Well, maybe it's because a volatility buffer was set up. Now, if you don't know what a volatility buffer is, I'll tell you. It's a large chunk of money in cash, fixed annuities, bonds, bond ladders, cash value and life insurance that you could go to if there is a crash, to keep that long-term perspective. And we may not have a crash. We may have a 10% correction, even this year, just as a kind of a breather of what's going on. So the Biden infrastructure deal, which, I thought people were supposed to be the party of fiscal responsibility and restraint. And we're not seeing any political party be for fiscal restraint at all. So then there's an article, 7 reasons why annuities have more value in 2021 than they did maybe before. Older investors have gains to lock in. High income investors have taxes to manage. So basically, maybe the tax deferral is a good thing. So give us a call, 800-321-0710 if you have a financial question. 800-321-0710 if you have a financial question. Now is the time to chime in. 800-321-0710. Now the article states this: the need for sources of protected lifetime income. Individuals cannot find sources of protected lifetime income that annuities can provide. The number of individuals with pensions continue to decline. So one of the reasons why annuities may have more value in 2021 is as a pension replacement. Also, risk management. Annuities are an insurance product, and this is becoming better understood, whether to protect principal, create income streams, or to take advantage of supplemental long-term care. So let's say you want long-term care insurance, but you are not healthy enough to get it, or you don't want to pay for it. Some annuities have long-term care benefits that you could get that would help pay for a live-in nurse when you're, of an older age and you need help bathing or dressing or eating, and you don't want to get shipped to a nursing home. We all know what happened last year with many who died. Many of the COVID deaths were people stuck in nursing homes. And death benefits, these products are insurance. One use that is increasingly common is to trigger guaranteed income as a hedge against sequence of returns risk for other equity assets. So what does that mean? Let's say you have 500 grand saved for retirement and you want $1,000 a month as income, but you're worried that if the market goes down, that's going to cause your 401k to become a 201k. Maybe you take 200, buy an annuity with that would produce an income of $800 to $1,000 a month, depending on age and other variables. Then you take the other 300, and you could be in a diversified portfolio of low-cost ETFs, also individual stocks. Right now, as indexes are up too, there are some great deals in the stock market. Some stocks are actually on sale. And we have an individual stock portfolio where we're seeing very good deals. So don't get a case of indexitis, meaning so many people, the index. Look at your portfolio and see if each constituency has value and merit. Call us at 888-988-JOSH, 888-988-JOSH, and we will review your portfolio at no charge, 888-988-JOSH. One use that is increasingly common is to trigger guaranteed income streams, also to protect equity market gain. Older individuals who have done well in the equity markets are looking for ways to lock in gains they have generated. Let's say you had $2 million a year ago, now you have $3 million because you took a lot of risk. Maybe take $1 million off the table. Maybe you had 500, now you have $1 million, whatever it might be. Maybe you have 50 grand, maybe now it's 200. Maybe it's time to protect some equity market gains. People who have done well in the equity markets are looking for ways to lock in gains that they have generated. Moving the money from pure equity products into most types of annuities protects their principal, including the gains. That's if you have a fixed annuity as opposed to a variable. So I'll go through the 7 reasons why annuities have more value. Number 1, the demographic steamroller continues. People are turning 65 at the rate of 10,000 people per day. 16.5% of the population is now 65 or older. So there is a growing age cohort of people moving from accumulating assets to protecting what they have and generating the most income from their capital. Also, the desire to protect equity market gains. We talked about the Biden infrastructure deal, not really, the market went up the last so many months, but since May, it's been stagnant. It's been like this. Hover around that 35,000, then it's down to 33.5, then it's up to 34.5. Then, so the Dow keeps it's like a yo-yo since May. What is the market telling us? Maybe people are concerned because of all this spending, all the potential inflation. Maybe you're concerned about your portfolio. Give us a call, 888-988-JOSH, and we will review it. So if you go into reasons why an annuity has more value in 2021, other individuals who have done well in the equity markets are looking for ways to lock in gains. We talked about this earlier. Moving money from pure equity into certain fixed annuities protects principal, including the gains generated over the last year or two. Tax deferral. One of the intrinsic values of annuity products is the tax-deferred buildup of accumulated interest. With income taxes likely to rise, Due to the Biden tax hikes, tax deferral is a very valuable characteristic that is often neglected. Number 4, risk management. Annuities are an insurance product, and this is becoming better understood. Here's the thing, the purpose is not growth. So some of you, you've accumulated enough money to be okay for the rest of your life. Why screw it up? And although we're not recommending you put all of your money in an annuity, why you should do your due diligence, seek to understand the internal fees, how long you have to hold it, all of that stuff, you may want to consider it as a way to take advantage of the benefits that I talked about: income, long-term care, and death benefits. Number 5, I said this before, but it's worth mentioning again: protected lifetime income. Many of you do not have a pension, and you need one. With interest rates on long-duration fixed income investments at record lows, annuities have become a more attractive tool. You used to be able to get a Ginnie Mae fund for 5%. Same Ginnie Mae fund's paying 1%. Annuities have better yields now than the old Ginnie Mae funds or even a treasury fund. We'll give you the 2 more benefits of an annuity. But first, we're going to go to the phone lines when we return from the break. So we'll talk about the 2 more reasons annuities might have value. And then we're going to go to Jerry, who seeks a better mutual fund. So we'll be back after these messages. This is Josh Jelinski, the financial quarterback. If you have a question, call us now, 800-321-0710. Don't touch that dial. Next up, Jerry with a question, calling us on our listener call-in line at 800-321-0710. Go ahead, Jerry.
Yes, I'm 80 years old, and I have a 12-year-old daughter and a 19-year-old son, and they're going to inherit the $500,000 that I have in the S&P 500. But the problem is I keep having to pay taxes on that roughly $6,000 in dividends. Is there anything that does as well as the S&P 500 without the dividends and in a mutual fund or something?
Well, number 1, you could call us at 888-988-JOSH for the free review. Number 2, you can buy index funds within tax-deferred annuities now. There's a whole category of no-load or investment-only variable annuities where for a small fee, sometimes they're as little as $20 a month, you can get tax deferral. So all those dividends that you don't like paying taxes on, which is essentially you're paying taxes on money you're not spending. So you could buy the same index fund within a tax-deferred annuity, number 1. Number 2, you could look for high-quality individual stocks that don't pay a dividend. So there are, if you think about Warren Buffett, his stock does not pay a dividend. Now, in full disclosure, I own it. And that's one reason for it, because I don't want to pay taxes on money I'm not spending. But, with anything, there's risks. You want to be careful. Then you want to look at maybe tax-favored investing. So there are tax-managed mutual funds where they try to mitigate that. You could also look at Roths. You could look at cash value and insurance grows tax-free and can be pulled out tax-free via a policy loan. So there are a whole host of options for you. You could also look at one of the big keys here is to not pay taxes on money you're not spending. So we mentioned investment-only variable annuities. Now those have the risk of the stock market, but so does the S&P. We mentioned Roths. We mentioned cash value life insurance. We mentioned stocks that do not pay a dividend, and we mentioned tax-efficient ETFs or mutual funds. So those are 5 things you may want to consider if taxes are getting you and your portfolio down. And also come in for the free review. We'll go over that at 888-988-JOSH for the 45-minute financial strategy session. So any other questions, Jerry, along that line?
No, that sounds good. I'll have to I recorded what you told me, so I'll listen to that a few times. So.
Now, the one consideration you want to have is with an S&P 500 fund, you have considerable risk in the market. And the indexes have done well, but in March of 2020, they were down significantly. So you have to be okay with the amount of risk you're willing to take, which seems like the risk is pretty high. And although the indexes have done well, except for like March of 2020, since the '08 crash, and the '08 crash, people lost, 40, 50% in index funds. So you have to be very careful. The other thing you want to be mindful of is if you have significant gains, for you to go into something that's tax-free, you might be paying capital gains. But if you can avoid those, $6,000 tax hits every year for the next, 10 years, you may also want to buy, do a gifting strategy so your kids can then have tax deferral. So you may want to set things up in their name. That way, maybe they're paying the tax at a lower bracket. So I hope that helps, Jerry. I'd love to meet with you at 888-988-JOSH. Next up, we have Rosemarie, who is trying to choose an annuity. Go ahead, Rosemarie.
Yes. Hello, Josh. Yes, I'm looking to lock in my investment into an income annuity because the investment that I was in, they suspended the dividends the last 15 months, and now they're not going to give it back. So I want to get out of that and lock in my income in an income annuity. What do you recommend? I don't know anything about annuities. Is there a fee to get into them? And is it revocable, or once you put your money in, and can you ever take it out?
It's a great question. Number one, there are irrevocable ones and there are revocable ones. So you want to be careful when you're choosing to ask that question. You also want to look at the fees. There should be no fees to get in, although I guess there are on some. Generally, there are internal fees and external fees. Internal fees would be an expense ratio on a mutual fund, for example, in a variable annuity. You might pay an income for life fee. Or there are annuities that have no fees, such as fixed annuities, fixed indexed annuities, or immediate annuities. Now, typically, you pay a fee for a rider. So, for example, if you buy a fixed annuity with an income for life rider, you may pay a fee of approximately 1%. That 1% may buy you a guaranteed monthly paycheck and not forcing you to annuitize, which means when you die, the asset doesn't die, it goes to your heirs. So the two biggest knocks on annuities are irrevocability. That only is with reference to what are known as immediate annuities. Most annuities have a term or a time period that you have to commit to. For example, 3 years, 5 years, 7, 9, 10, as high as 14 or 16 years. But after the end of the term, let's say you do a 10-year annuity, after 10 years, the money's fully liquid. If you do a 12-year annuity, after the 12 years, it's fully liquid. If you do a 5-year annuity, it's fully liquid. So you can choose the number of years you have to hold it. You can buy a no-fee annuity or a very low-fee annuity. You just got to shop around just like anything else. And we have an annuity shopping service. If you call us at 888-988-JOSH, where we could, we get your age, we get the state you live in because they're state dependent, and then we look at your criterion, whether you want fixed indexed, immediate, or deferred. Does that make sense?
Yes.
So generally, and then there's basically the time period, the fees, and what type. So time period, fees, and what type. Those are the three biggest questions. And then what we do is we'll show you a printout of the top three in your category based on our shopping. So that way you can pick, we shopped around, so you don't have to feel, like you didn't do your due diligence. Does that make sense?
Yes. Is that service free, or is there a charge for that?
Well, there's no charge for the 45-minute strategy session where we'll shop it around and show you different things. No.
Okay. Would it be possible for me to mention the two insurance companies that I'm interested in, or not?
No, we would prefer you handle that in the in-person meeting, just because I don't want to give, unless they're advertising on the show, or we don't want to besmirch a particular company over the air. So
I see.
If I don't particularly like the annuity, But if you call us for the 45-minute strategy session, we'll do that for you at no charge, okay?
When should I call?
Oh, call us now. 888-988-JOSH. We have clients there right now.
Okay. All right. Thank you very much.
Yeah, we also have staff picking up the phone lines. They do a great job every week. David, Rich, Jim, and the team are there right now at 888-988-JOSH. And, just like the beautiful thing about our shopping services is you tell us the criterion. Now, you may not even know the criterion, but then we'll educate you. Okay, here's a fixed, here's a variable. Variable, your money is in the market, but you're paying extra fees for guarantees. Fixed, you're paying no extra fee. It's just, you make 3% for 5 years or 2% for 5 years or whatever the going rate is on annuities right now. And then fixed indexed is kind of like a hybrid where it's principal protected, but the interest that you earn is credited based on the performance of an underlying index. And then there's immediate, which they just give you monthly checks in exchange for typically irrevocability. However, there are ones that have a 10-year out clause in some of them, and we can talk to you about those. But don't throw the baby out with the bathwater when buying annuities, because some people say, oh, you're tying up your money forever. You don't have to. Oh, there are high fees. You don't have to. So just like anything, there are high fee mutual funds and low fee mutual funds. There are high fee annuities and low fee annuities. So it's a tool, generally for conservative income. So thanks so much for calling, Rosemary, and I hope to meet you soon. So folks, the final two reasons why annuities have more value is life innovation. Insurers have brought new product structures to the market, new strategies, products focused on the needs of the RIA community, now that are more fiduciary friendly, and adding innovation features such as long-term care benefits and the ability to pay for advice from the annuity product without triggering income tax. That used to be one issue. And then finally, leveraging product efficiencies. So when purchasing an annuity product, the buyer is receiving, this from Harry Stout, is receiving the professional asset management capabilities of a life insurer, asset liability management expertise, actuarial knowledge, and mortality credits from insurers having large books of business and state-based solvency regulation behind the capital the insurer has deployed to support the business. So there's a lot of benefits there: tax deferral, flexible income, limited liquidity, accumulation provisions, and payout guarantees. So with historically low interest rates, if you're looking for ways to get more yield, call us at 888-988-JOSH, 888-988-5674. We'll be back after these messages.
The preceding program was sponsored by the Jelinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jelinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to affect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.